Hello traders, and welcome back to Explain the Charts. Today, on October 12th, 2025, we're doing an in-depth analysis of GBPUSD, also known as cable. It's been an incredibly volatile week for this pair, with major news driving some dramatic price action. We'll cover all the crucial headlines and then dive into the charts to see what they're telling us about the short and long-term outlook. First, let's talk about the fundamental picture, which is currently dominated by events in the U.S. The ongoing U.S. government shutdown is creating significant risk-off sentiment in the markets. This uncertainty has been driving investors towards the safe haven U.S. dollar, putting pressure on other currencies like the pound. Compounding this is a clear divergence in monetary policy between the two central banks. The Bank of England is striking a more dovish tone, with policymakers hinting that restrictive policy is needed for longer due to a fragile UK economy. In contrast, the U.S. Federal Reserve, while acknowledging some easing inflation, is seen as having less room to cut rates, especially under the new Trump administration's policies. In fact, some analysts are pricing in up to 3 rate cuts from the Bank of England in 2025, which is a major headwind for the pound. News outlets have been buzzing about the recent price action, with headlines highlighting a crash to 1.3300. Analysts point to crumbling investor sentiment and the strength of the greenback as the primary drivers. They've identified key technical levels, with the 200-day moving average around 1.3280 acting as the last major support. If that level breaks, we could see a deeper retracement towards summer lows near 1.3140. On the flip side, any recovery attempt will face stiff resistance around the 1.3400 level, which was a recent area of consolidation. Now, let's switch over to the charts and see how this news has translated into price action. We'll start with the daily chart to get the big picture view of GBPUSD. Looking back over the past year or so, we can see a strong uptrend that started in early 2025. The price rallied significantly, eventually peaking in late June at a high above 1.37. However, since that peak, the momentum has clearly shifted. We've been in a consistent downtrend for the last 3 months, making a series of lower highs and lower lows. The last month, in particular, has seen a significant acceleration to the downside. Let's zoom in on the price action since September to get a better look at this recent move. Here we can see the failed attempts to rally back in mid-September, where price topped out around 1.372. After that failure, the sellers took firm control, pushing the price down aggressively. Notice the break below the consolidation area around 1.3450 in late September. That breakdown was a key technical signal that more downside was coming. And that's exactly what we got, culminating in this huge red candle on October 9th. This is the crash the headlines were talking about, where price plunged through 1.3400 and briefly touched below 1.3300. The low of that day was 1.3278, which aligns perfectly with the 200-day EMA that analysts were watching. Following that dramatic drop, we saw a bounce on October 10th, with a green candle closing back up near 1.3350. The critical question now is whether this is a genuine reversal or just a temporary relief rally before the next leg down. To get a better idea, let's drill down to the 15-minute chart to analyze the recent price action more closely. Looking at the price action from October 7th, we can see the clear downtrend that led to the crash. Price was trading above 1.3420 before it started to slide. The sell-off was relentless, with very shallow bounces that were quickly sold into. This indicates very strong bearish momentum during that period. The decline accelerated dramatically on October 9th, taking out several minor support levels. We can see the bottoming action around that 1.3280 level, where the selling pressure finally exhausted. The recovery on October 10th was quite strong, reclaiming about half of the losses from the prior day's crash. However, the price appears to be finding some resistance around the 1.3350 to 1.3370 area in the very short term. For now, the price action is contained in a small range as the market digests the big move. The structure of this bounce is important. If it starts to form a bearish pattern like a flag, it would suggest continuation of the downtrend. Conversely, if it can consolidate here and build a base, it might be able to stage a more meaningful recovery. Let's pull back to the daily chart to put this all into context and define our key levels. Based on the fundamental picture and the technical breakdown, the path of least resistance appears to be to the downside. The primary bearish confirmation would be a daily close below the recent low and critical support zone of 1.3280 to 1.3278. A break of this level would open the door for a move towards the next support area around 1.3200. This is a significant psychological level and also aligns with some previous price action. Below 1.3200, the next major target for sellers would be the summer lows around 1.3140. On the upside, the bulls have a lot of work to do. The first major hurdle is reclaiming the broken consolidation zone around 1.3400. A move back above 1.3400 would be a positive sign, but sellers are likely to reemerge there. The more significant resistance level sits between 1.3465 and 1.3490. This area represents the weekly open and the opening range high from the prior week. Only a decisive break and hold above 1.3500 would begin to shift the broader bearish sentiment. Until then, rallies should be viewed with suspicion. So, to quickly recap the critical levels we're watching. Immediate pivotal support is the recent low around 1.3280. Below that, key supports are at 1.3200 and then 1.3140. Immediate resistance is the 1.3400 level. Above that, major resistance lies at the 1.3475 to 1.3490 zone, and bearish invalidation isn't really considered until a break above 1.3587 or even 1.3625. Now for some potential scenarios. The bearish continuation scenario seems most likely, with about a 65% probability, given the strong fundamental headwinds and the decisive technical breakdown. This would be reinforced by a failure to rally past 1.3400 and a subsequent break of the 1.3280 support. A bullish reversal scenario, where this bounce marks a significant bottom, has a lower probability, maybe around 25%. For this to happen, we would need to see a strong push above 1.3400 and likely some positive catalyst, like a resolution to the U.S. government shutdown. There's also a 10% chance we simply see sideways consolidation between 1.3280 and 1.3400 for a while. Going forward, the most important thing to watch will be developments regarding the U.S. government shutdown, as it's the primary driver of risk sentiment. Also, keep an eye out for any unscheduled comments from Fed or Bank of England officials reacting to the market volatility. Their tone could provide the next directional clue for this pair. Finally, please remember that this is not financial advice. This video is for educational and informational purposes only. Always conduct your own research and due diligence before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next one.